I am the co-founder of a 3-year-old software as a service business in the edtech space. We have raised $5 million in 2 tranches, 1 round from angel investors and 1 led by an institutional VC. The recent impact of virtual life and learning has elevated the need for the services we provide to school districts. Our average contract is between $30,000 to $50,000 per year, and we have 75 school districts on board with a robust pipeline of over 200 potential contracts worth about $8 million in ARR. Our current annual run rate is $3 million. Due to the federal financing for education, our contracts only go out 1 year, but our attrition rate has been 0, which we're really proud of. School systems pay up front for annual contracts, usually during Q2 and Q3, when we are flush with cash. We are considering raising more capital to allow us to scale faster, but my co-founder and one of our investors want us to at least consider maximizing value in order to be acquired over the next 24 months. So I have a few questions for you. Thanks for joining me in the conference room today. So Mike, let me start with you. What's the process we should use to value our business? How do multiples play into the formula? And are there financial strategies to maximize value for acquisition in 24 months?
Well, Steve, most companies use the EBITDA formula to value businesses, which is earnings before interest, taxes, depreciation, and amortization times a calculated multiple value. EBITDA is a measure of a company's overall financial and corporate performance that presents earnings before the influence of accounting and financial deductions. Lucky for you, Steve, your company is a SaaS company that's generating recurring revenue preferred by most investors. The market is in a favorable SaaS mode now, where companies are stretching valuations levels by valuing SaaS and cloud companies on multiples of revenue instead of multiples of profit. So this typically equates to much higher business valuations. So since your co-founder wants you to sell the business in 24 hours and realize the maximum value, the best thing I could recommend to you is to generate as much recurring SaaS revenue as possible in the next couple of years.
So Dan, we're focusing on that 24-month period, and a number of my management team members keep asking the following question. When focusing on selling, what primary KPIs drive the value of the business? For instance, revenue, profit, growth rate, rule of 40, churn, and other items.
So Steve, for a company like yours, I agree with Mike. Your focus has got to be on recurring revenue. In your case, ARR, cash collections. So a wise man once told me, you could ask that same question to 3 people and you're going to get 3 different answers. I forget who that guy was, but I think he's on the screen. But the reality is, I like to focus on customer acquisition costs, and I like to focus on lifetime value. Now you begin to pull back on the derivatives of those 2, because that's actually going to drive some of the other probably concerns you're going to have, such as accounting and how to capture that information. But in terms of KPIs, I'd be focused on AR, cash collections. In terms of like other business fundamentals, I think customer acquisition cost is probably your biggest one, especially if you've been around for only 3 years, because you've probably seen it oscillate, right? In the beginning, you've got greater intimacy with your customers in the market because you probably have the 2 or 3 anchor customers. And then as you're looking 24, 36 months out, it gets tougher to acquire customers. So making sure you've got a good balance between customer acquisition costs and lifetime value is critical. I'd also be looking at deferred revenue, because deferred revenue is essentially what's sort of on the balance sheet waiting to be serviced, if you will. So I'm not sure if I kind of answered all your KPI questions, but I mean, we could spend all day looking at all the potential KPIs, but I think it comes back down to, is my go-to-market strategy effective? And is it showing in my customer acquisition cost? And am I making money, right? Am I acquiring new contracts, and am I making my gross margin targets?
So thanks, Dan. We've been able to scale very rapidly, in fact, more rapidly than anyone expected. We've never really focused on fundamental accounting and finances during this 3-year period. We have a bookkeeper, but we have never hired a more or hired or elevated a financial professional. What are the 3 top things that the company and I should do to prepare for the eventual sale in terms of accounting and finance function?
Cool. So I always say it's usually not the people that are the problem, right? It comes back down to the systems and policies and procedures. So maybe it's not, let's focus on what buyers are going to want to understand. That goes back to your customer acquisition cost, recognized revenue versus cash collections, and then lastly, your deferred revenue. So sure, having a bookkeeper for the first 3 years, I'm a big fan of not future-proofing, right? I've seen companies spend thousands and thousands of dollars on, sort of like mid-sized company, enterprise-level software, when really a couple of spreadsheets or QuickBooks could have just been just fine. So to answer your question on the top 3 things, focus on your accounting policies and procedures. Secondly, understanding whether your P&L and your balance sheet actually reflect your business model. When companies start off, it's like money comes into the bank account, money goes out of the bank account, and it gets recorded that way on your general ledger. But Mike is going to tell you, well, you're going to get the most value by having enough of that deferred revenue on the books, showing that recurring monthly revenue. And then the last thing is establishing the cadence and rigor around your monthly financial reviews and reporting, so you know the numbers, you own the numbers. So part of this does come down to capability, of course, right? Having just a bookkeeper at your level, Steve, it may behoove you at this point to start thinking about, as you're creating more cadence and rigor around your accounting reporting, think about maybe identifying a fractional controller. That individual could help your bookkeeper and provide the leadership that he or she needs to begin to elevate your accounting so that it does better reflect your business model. I would say that's number 1. Number 2, start thinking about, can I do this alone? If I had a CFO behind me, could that individual help me have those more elevated conversations with Mike, with Peter, begin to be that intermediary? Because it's not always just about the financials, right? There's going to be human aspects to this, and yeah, I would say think about the CFO later on.
Okay, no, that's great advice. And Peter, I want to get you into the conversation. I've had several friends who have sold their businesses, and once we get into an acquisition conversation, in terms of deal structure, I've heard that earnout should be avoided at all cost. I'm told that 90% of the time they never come to fruition. So is there anything that can be done to maximize the chance of avoiding an earnout? And how would you recommend we think about purchase price?
Sure. Just to be clear, an earnout is a part of a purchase price that's going to be paid later based on the performance of the company after it gets sold. And so you focus about what's being paid at closing, usually cash in a lot of these situations, and what's paid afterwards, which may be cash, but it's going to be conditional on your achievement of certain revenue and other goals. So I'm not a fan of earnouts, but I'm not sure avoiding them at all costs is the right approach. They're often a good way of bridging perceived differences in value. But really you have to think of them, I think, as more of a lottery ticket, which is to say, you have to be satisfied that if you never get a payment on the earnout, you're still okay, at least selling the company. You're not disappointed and say, I never would have sold it that much. So for example, if you had a situation where you're happy to sell at $10 million and someone says, well, I'll give you $9 million, but a $3 million earnout, yeah, that might be okay. If you say, I'm happy to sell at $10 million, they'll say, well, we'll give you $5 million and a $10 million earnout, even though that sounds like you might get a lot more money, you're probably not going to. So the problems with earnouts basically are they rely on the operations of the company afterwards, which is not under your control. And they also rely on information about the company, which is not under your control and often difficult to get. And in particular, what you've said here is that you're considering raising capital to scale faster. So part of your success may be the revenue, the financing that you will raise over the next 24 months to scale. And the question is, will the person who's controlling the earnout, the acquirer, be able to promise you that kind of support? And likely as not, they won't. So it's easy to measure cash against your goals. It's very hard to measure earnouts. It's only when you're very close to your cash goals or your exit goals that an earnout can be a helpful thing.
Yeah, I would add one last thing to that, Steve, is when you are designing an earnout program as part of the purchase price, make sure the metrics are measurable. Make sure that you can actually observe them. Don't leave them to having arbitrators or lawyers interpret those metrics. Making sure that the layman can actually understand, like, what am I on the hook for?
Yeah, and one last thing also, that if the metric is tied to your keeping as an employee, it may turn out to be a very different taxable result. It might be ordinary income instead of capital gains. So you have to be kind of careful about that.